Hey there, and welcome. Today, we're going to get into something that's at the absolute heart of finance, risk. But we're going to do it a little differently. We're going to uncover the secret of the wobble, a simple idea that I promise will completely change how you look at every single investment. Let's dive in.
All right, to get us started, let me throw a little puzzle your way. Imagine you're looking at two different investments. We'll call them investment A and investment B. We're just going to look at how they did over a 3-year stretch. Okay, so check this out. Investment A, oh man, it was all over the place. A huge 30% gain 1 year, then a painful 20% loss, but it bounced back with another great year. Investment B, on the other hand, was way more chill, just steady, positive returns. But now, look at the very bottom line. If you just look at the average, investment A comes out on top.
So, looking at just that one number, the average, you'd pick investment A, right? I mean, it seems like a no-brainer. But is it really that simple? Turns out, there's a huge piece of information missing from this picture. And that missing piece of the puzzle, well, that's what we're calling the wobble. Think of it this way. The average return tells you where you ended up, but it says nothing about the ride to get there. And in investing, that ride, how much the returns jump around, that's pretty much the definition of risk.
And, this isn't some brand new idea. Way back, this economist, Harry Markowitz, was looking around and he was just baffled. He saw that everyone was making these huge decisions based only on the potential returns. Nobody seemed to care that some investments were these smooth, steady journeys, and others were, well, total roller coasters. He knew that variability, that up and down, had to matter. So let's just nail this down. What is risk? It's simply how much the return varies. Anytime it zigs or zags away from what you expect, that's risk. That's it. This wobble around the average is the big secret we're trying to figure out. The bigger the wobble, the bigger the risk. Simple as that. Okay, great. So we know what the wobble is, but how in the world do you measure it? I mean, how do you put a number on something like that? Well, this is where some statisticians came up with a really clever trick. Now, the first thing they tried, it just didn't work. It was super frustrating. If you take all the returns for each year, see how far they are from the average, and then add up all those differences, you get 0. Every single time. The ups and the downs just perfectly cancel each other out. So it was a total dead end. So to get around this problem, they came up with this awesome process. First, you calculate the average, easy enough. Then you figure out how far each year's return deviated from that average. And now, here comes the clever trick. Step 3, you square every single one of those deviations. What does that do? It makes all the negative numbers positive, so they can't cancel out anymore. Brilliant, right? Then you just average those new squared numbers, and for the last step, you take the square root to get everything back into a unit that actually makes sense. And that step in the middle, the average of all those squared differences, that actually has a name. It's called variance. It's a super useful number for telling us how spread out everything is, but the units are kind of weird because they're squared, not super intuitive. So to fix that and get back to a number we can actually wrap our heads around, we just take the square root of the variance. And that gives us the standard deviation. This right here, is our wobble score. It's the one number that tells us exactly how wild the ride is. The higher the number, the more risk, the bumpier the ride.
All right, so that's the theory. A little bit of math, but we got there. Now, let's put this thing to work in the real world. We can use our fancy new wobble score to look at what's already happened and to try and peek into the future.
First up, let's look backwards in time. We've got a stock here with 5 years of actual performance data. So the average return over these 5 years was pretty good, right? Almost 27%. But just look at those deviations. 1 year it was down more than 34% from that average. Another year it shot up over 35%. I mean, that is a serious wobble we're talking about. And when we crunch all those numbers, when we do the whole squaring and square root thing, we get a wobble score, a standard deviation of 31.5%. There it is, a solid number that tells us exactly how risky this stock has been in the past. Okay, looking back is useful, but what about looking forward? I mean, that's what we really care about, right? We can't know the future for sure, obviously, but we can use the exact same logic to make some really good educated guesses. Instead of looking at past years, we can map out a few different scenarios for the economy and guess how our stock might do in each one. So, in this case, let's imagine there are 4 possible ways the economy could go next year. Everything from booming, high growth, all the way down to a nasty recession. And let's say we think each one has a pretty equal shot of happening, about a 25% chance. And for each one, we've estimated what the stock's return would be. Okay, so the very first thing we have to do is figure out our best guess for the overall return. Since each scenario has a different probability, we can't just average them. We have to find the weighted average of all the possible outcomes. And when we do that, our single best guess for what this stock will do next year is a 6% return. Now we can finally measure the expected wobble around that 6% return. We run the exact same calculation we did before, but this time we use our future scenarios and their probabilities. And what do we get? A forward-looking wobble score of 9.29%. This gives us a real sense of the kind of risk we're signing up for over the next year.
So we've gone through all this to learn how to measure the wobble. But what's the big deal? Why does this actually matter to you as an investor? Let's tie this all together for the final reveal. Hey, remember that puzzle from the beginning with investment A and investment B? Well, investment A did have that higher average return. But now we know the real question to ask. If we actually calculated its wobble score, we'd find it was way, way higher than investment B's. That better return came with a much wilder, much riskier ride. Without knowing about the wobble, you were basically investing with one eye closed. So what are the big takeaways here? First, risk isn't some scary monster. It's just the variability of returns. It's the wobble. Second, standard deviation is the tool. It's our wobble score that lets us measure it. Third, a higher score just means a bumpier ride. And finally, and this is the most important part, understanding this whole concept gives you so much more control. It lets you make smarter decisions that actually fit with how much of a wobble you're comfortable with. So now you know the secret of the wobble. The only question left is, how is this going to change the way you look at investments? Next time you hear about some incredible high return opportunity, maybe you'll be the one who stops and asks the most important question of all. Yeah, but what's the wobble? Thanks for joining me.